First, we need to analyze what's going on, and then we can draw conclusions. When we announced that we want to preserve financing conditions favorable, it was in December last year, we had in mind, in a way, a sort of forward guidance, which is different from yield curve control of the Bank of Japan. So this is not meant to be a mechanistic reaction to one single variable, but it means that we look at a whole set of indicators and a broad set of indicators that reflect the financing conditions for the non-financial sectors of the economy. So sovereign yields are just one element of these. And there's also, of course, also the financing conditions for corporate, et cetera, et cetera. So we need to look at this broad range of indicators. We need to look at it in real terms, in my view. And then we need to analyze the root causes for the movement, because we would react differently if yields rise because of inflation expectations picking up, or because the economic outlook is improving, to an exogenous increase that we would label unwarranted. So it's very important to look at the root causes, and that is what we should do in the next Governing Council meeting. And we also, of course, have ways to react to this, to adjust. I mean, the PEPP comes with flexibility, and we can use this flexibility to react to such a situation.
Would you say that flexibility also would entail to increase the run rate of purchases, because they're currently below 20 billion euros a month?
Well, as you know, I don't speculate about future decisions of the Governing Council. But of course, this is one element that is on the table, to use the flexibility we have in implementing the PEPP. But again, the first step is to analyze the root causes, and also to see what effect we have on our ultimate objective, which is price stability. So in a sense, it matters what the effect is of these changes in financing conditions on the inflation rate in the medium term.
The inflation rate, it's kind of surprising to hear that you think the inflation rate will climb to 3% by the year end. So does this give like more ammunition to the hawks inside this Governing Council to actually think about tightening monetary policy?
I think it's important to disentangle the short-term development over the next couple of months and the medium-term horizon that is relevant for monetary policy. What I said during the press conference was that we expect at the end of the year, in the second half of this year, inflation rates in Germany that hover around 3%. But this development is driven by three special factors that also are temporary by nature. So it will not affect the inflation rate in the medium term. And this is changed weights in the HICP. It's energy prices, which also has to do with CO2 pricing in Germany. And it's the end of the reduced VAT rates we had in Germany. And all those three effects combined account for 2 percentage points in inflation. So explain 2 percentage points of this rise from December to January that we have seen. But it will vanish over time because it's mostly one-off effects.
So in other words, if you're saying as well that the monetary policy stance will remain as low or as accommodative as it is now, lower for longer, you have like a multiple year time horizon in your mind?
What we see in our forecast is a very gradual rise in the underlying inflation trends. But of course, there's a lot of uncertainty regarding how this withhold consumption or this withhold demand will unfold once the restrictions are lifted, for instance, but also with respect to wage dynamics. I mean, for inflation to pick up in a more sustainable manner, we would need wages also to increase. And that's not what we currently see. But we have to watch carefully how these higher inflation rates at the end of the year will affect wage negotiations and wage dynamics.
That actually brings me back to the question of whether this crisis we are currently in has added a lot more slack to the economy, because I remember that we have been discussing that on various occasions, that there's still too much slack in the economy in the Eurozone, which prevents actually wages from rising.
Well, in particular, I think in our estimates of the Phillips curve, we see that the Phillips curve is rather flat. So changes in the utilization or capacity utilization are not reflected in very strong increases in the inflation rate. So that's for one. But again, there's a lot of uncertainty, and even more so now with respect to capacity, because it's very difficult to judge how the pandemic will affect our potential output. And thereby, it's also very difficult to see or to have a very concrete measure of output utilization.
That brings me back perhaps a bit to the economy. So if we look at Germany, it seems to be going quite well despite the lockdown and this very long lockdown we are in. How much do you think that upholding of the economy is actually real, and how much is just because we have so much fiscal stimulus and aid, and what is left afterwards?
Well, that's one of the core questions also, to judge when to end the fiscal stimulus. But what we saw last year was that once the pandemic is under control, once the restrictions are lifted, that consumption rebounds quite strongly. And that's also confirmed by the surveys we have been undertaken. The massive increase in savings that we have observed are less linked to motives of economic uncertainty, so fear of losing the job, for instance, but more linked directly to the restrictions of the pandemic. So in a sense, once these restrictions then are lifted, this speaks in favor of a very massive rebound. On the other hand, we have to see that our surveys also show that the savings have particularly risen with high-income households, and they have a different consumption behavior, which kind of counterbalances a bit the first effect.
Let's briefly also talk about the disappointing rollout of vaccines in Germany. As the Financial Times is coining it, we went from like the COVID champion to really a lagger in combating that crisis. So how disappointed are you about like our poor logistics in that respect?
Well, this is not really a judgment I can make as a monetary policy maker. Let me just reiterate one point. The quicker we overcome the pandemic through medical solution, the better it is for the economy, but also for the people more broadly. So a successful and quick vaccination campaign, in my view, is key to that end.